Dan Kelly, how are you, sir?
Never better, Tom.
I like your
Thank you.
background. Are you on is it a cloudy day near you? Looks
Now,
like
it's just really gray. Really gray.
it's really about your attitude. If it's your attitude can make that bright, you know?
That's right. That's right. I have a I have a Zoom background that I forget to turn off even when I'm in my office and I leave it alone. So there it is.
There's no judgment, no judgment. This isn't a real background.
Oh, it's not? Oh,
No.
I could have sworn it was.
Well, the more you know.
You look like you're in the Ozarks.
Thank you. You ever seen that show?
No?
Me either. Me either.
Should
No.
I?
Dan, today, very important topic.
I'm ready. I don't know what we're talking about. Go ahead.
We're talking about how to evaluate climate tech hardware companies
Oh yeah,
and what deployment stage investors look for. A topic that's very near and dear to you.
it is for many reasons.
Yeah, so let's talk about the blind spot. All right, so capital's moving into climate tech hardware faster than most investors' evaluation instincts probably have even evolved. Many are still running software era diligence on physical companies. But, Mr. Kelly, from your seat, what do deployment stage investors most consistently get wrong when they size up a climate hardware company? And what does that mistake actually cost them?
Good question. It ultimately depends on the background of the investor, and your comment was related to software investors. Software investors have a significantly difficult time looking at anything hardware related.
Mhm.
Um, the models just don't match, and so it is the reason you have this massive bifurcation in the venture capital community between, let's just call it all things IT software, and then everything else. And that's the reason, quite frankly, that Silicon Valley is focused so much on software because it's a very understood, repeatable model from a metrics perspective. On a climate perspective or a hardware perspective, it's a little bit different. Quite frankly, the hardware companies are more durable and longer lasting, but they may be slower on the uptake from a conversion perspective. So it has a little bit to do with what the investor's appetite is and overall focus from a roadmap and timeline. Some people want to have an exit in 5 years. Some people want to hold on to an asset for 20. And so the bottom line, though, is what people primarily miss is that they don't miss reviewing the technology. What they miss is they miss reviewing the actual business model, right?
Yeah.
And so they back really good technology, but on the wrong business model. That's what I would say. And ultimately, it's the reason that I've made some major changes myself in different businesses that I've been involved with, especially with ADAR, focusing on recurring revenue, because there are ways in which you can actually make a hardware business into a recurring revenue machine that Warren Buffett would love to invest in.
Boring businesses, right?
Yes,
Yeah.
we're in business.
Yeah.
Yes.
No.
Ultimately, I like to make businesses that are just cash cows that nobody knows about.
Yeah. No.
And
No.
that's the beauty of this space. And it's way misunderstood and underlooked, I'd say. Yeah.
Yeah. Very well said. All right. So let's say a deployment stage investor handed you a term sheet tomorrow and gave you 1 hour. What would your eval framework actually look like? I guess like the questions you'd ask in order and what each one is actually testing for. And lastly, last part of this, if you had to give that framework a name, if you had to give like a name that that framework could be called that an LP would remember, what would you call it?
I'll answer that last one first. I'd call it basically follow the machine,
Hmm.
otherwise known as follow the money, right?
FTM,
Um,
FTM.
FTM,
Yeah.
uh, not to be mistaken with GSD.
Yes. 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 But I
But
get it. Yeah.
ultimately, you've got to follow the money and how it flows through the machine. And that's the easiest visual I can give people. Why does this space have kind of a bad name or boring characterization by the investment community globally, especially in America? Because you think of it as a clunky hardware business.
Hmm.
The difference between clean tech and software is that clean tech just is actually something physical, creating an outcome that people need. Software is something that people may or may not need that just helps them get more efficient.
Sure.
So the bottom line, though, is that it's been a good challenge for people that make hardware because the primary problem with the clean tech space is it's largely been run by engineers that aren't really good business people historically. Not
Yeah.
all, of course, but historically. And as a result, people keep thinking about how do I sell hardware into the market? And that's perfectly fine for people that are creating widgets or one-off goods, etc. There's nothing wrong with it. I'm not knocking it. But what I am saying is that it's not investable.
Yeah.
Okay. And so the question is it investable? What's investable is when we create moats with recurring cash flow through the entire unit
Yeah.
at the beginning of the unit and the end. So I think you asked me for basically four questions I would ask. Is that right?
Yes.
Yeah.
Ideally in like sequential order.
Okay. The first question I would ask is who owns the underlying asset
Great question.
and what does that contract actually sell? Does it sell hardware or does it sell an outcome?
Yeah.
Okay. And that ultimately tests where the risk lives on within the commercial equation, on the manufacturer or on the customer, right?
Yeah.
Um, Second question is, again, nothing matters in these businesses other than, quite frankly, real demand.
Yes.
And so I would ask for someone to show me a signed contract.
Yeah.
That is a ultimately a take or pay is my preference, but I think we'll probably talk about that later.
Yeah.
Um, the third is show me the P&L, profit and loss statement on a physical asset.
Okay.
So literally show me the unit economics of
Mhm.
the asset. Um, and then I think yeah, fourth question would be uh, this kind of relates to the moat. What protects you in 10 years when China rips you off?
Hmm.
Right.
Yeah.
Right. And there's no perfect answer for that one, but it ultimately has to do with, well, what is actually the connected ecosystem that's going to support you versus just being a hardware company that you're trying to protect with patents, which never works,
Yeah.
ever, ever. So probably a longer-winded answer than you were looking for, but that's what I would look for, is essentially follow the machine.
I love it. Great answers. Thank you.
You're welcome.
I wouldn't have been able to do the chronological order as well as you did, but those questions make sense.
Well,
Um,
it's from experience.
yes,
I've
naturally.
been burned many times before, Tom, by not asking all those questions.
Yeah. I mean that'll do it. Yeah. All right.
It makes you smart pretty quick. Yeah.
Yeah, of course. Trial by fire.
That's right.
In that scenario. All right, so two companies can run identical machines and be entirely different investments. So one sells or leases the equipment, then the other one keeps the asset and sells what it produces. How should an evaluator weigh business model against tech, and what does each model reveal about, I guess, the risk where it actually lives?
The It's a great question. The first model you just described is essentially when someone is selling or maybe even leasing equipment. And so the problem with selling equipment is very clear. I have no interest in hardware companies that sell equipment.
Yeah,
And quite frankly, newsflash, neither does the market.
yeah.
I can say that very confidently,
Mhm.
very confidently. Okay. Why? Revenue is lumpy. The customer is inconsistent. You're priced like a capital goods company, and you just need a constant hardware or capital infusion to build hardware.
Yeah,
And and ultimately, this is why there's a million different equipment financing companies out there that all just create margin off of these businesses that are literally constantly capital constrained on cash flow.
yeah,
Okay. The other model is the recurring revenue model, where ultimately either the company itself maintains the asset and is simply creating a cash machine from the asset, or it deploys an asset against a customer, but still has a recurring revenue model on that underlying asset. And so, what I look for as an investor is I look for basically a 5 to 10 year, 5 year being minimum, 10 year being the projection on what is the overall revenue created from that one machine over a 10-year period. And again, it's very simple math on a hardware sale.
sure.
Most hardware sales are lucky if they get 30%. I've never done anything for under 60% margin, I'm
Yeah,
saying.
yeah,
But those numbers, that sounds great from a percentage basis, but they are dwarfed 3 or 4 or 5 times when you can use that same asset to create a recurring revenue asset from
Yeah.
it.
Yeah,
Um, did I answer your question?
absolutely did.
Okay.
All right, well, let's talk about the quality of revenue now. So climate hardware pipelines are full of LOIs, pilots, MOUs that get presented as traction. Where do you draw the line between interest and demand, and what does a take or pay commitment signed before an asset even deploys prove that a successful pilot never can?
Yeah, um, this is a tough one because I can speak out of both sides of my mouth here
Yeah.
because I have been both an investor and an operator.
Yep.
Okay. Um, from an operator perspective, I know you're asking me from an investor, but let me
Yeah.
answer it
Yeah.
actually in
Please.
both ways. From an operator perspective, it's really important to get your prospective customer, especially as an early stage business, to sign something, to just put their name behind you so you can show the market something, right? When you're doing a raise or even applying for insurance, right? Stuff like this. Unfortunately for investors, putting my investor hat on now, that really means nothing unless you have a specific roadmap on
Yep.
exactly what a proof of concept or a pilot, all mean the same thing really, will achieve, and specific milestones that a customer will pay
Yep.
when the company meets or exceeds those milestones. That's really the difference. And so I've had companies come to me all the time with a whole bunch of fabricated LOIs, a whole bunch of fabricated different things. Quite frankly, some of these people were bad actors, which I don't work with anymore, obviously.
Sure.
Others are just people that are scrappy, trying to get stuff done, and are just trying to show anything.
Got
But
it.
unfortunately, it's kind of like throwing a bunch of crap at the wall, right? That's nice, but what really matters is when you have an offtake agreement and a take or pay, meaning that the end customer is responsible for taking that
Yeah.
so long as you meet the objectives. That's what matters, and that's what, quite frankly, is you can get financing behind. And I'll tell you what, as much as I hate the finance markets, it makes you real quick appreciate the due diligence because these are the ones that are getting burned constantly.
Yeah.
And so it's important to learn. It's important to learn from the finance guys as much as you might hate it from the operator's perspective.
That was a well-balanced answer. I feel like I just had a good breakfast.
Thank you. Yeah, meat and potatoes,
Wouldn't go that far, Dan.
some, maybe some scrambled eggs.
There you go. A little bit of cheese on it. Okay. Strip away the total addressable market slides. So, like at the level of a single deployed asset, like which numbers tell obviously a deployment stage investor whether a hard which numbers tell the deployment stage investor whether a hardware business is fundable. So like if you can walk through the math of like what you'd want to see per unit and the thresholds that separate a real machine economy from like a science project.
Well, great. To be frank, no disrespect to anyone, but the majority of this hardware space is a science project for a lot of these. A
I
lot of
said
these,
I said that tongue in cheek, you know.
I know.
Yeah,
That's the problem, though,
yeah,
right?
yeah,
And
yeah.
it creates a lot of noise against those business models that are. The funny thing is that, let me tell you a short story.
Yeah,
Um, in my career, and even representing ADAR now for a second, because that's part of my career here.
sure.
Uh, when I bring a project to a financer and it creates an internal revenue return, they call IRR, right? These
Yep.
project finance guys are all looking for basically 10%. They're scraping at the walls because they're used to solar companies or paralysis machines or blah, blah, blah that have a 10-year payback period, et cetera. When you bring an IRR that's closer to 30% versus 10%, the instant reaction when it's the first time, nobody believes you.
Yeah,
Nobody, because they're all used to this hardware business of saying, well, we're going to have a 10-year payback period, and maybe in year seven, we'll break even.
yeah,
It's ridiculous. It's ridiculous, and it's unfortunately what the industry has come to accept, specifically the climate tech industry, because everyone was literally sucking at the teat of the government funding machine.
yeah.
And when you have an asset, I'm answering your question in a long way just with a short story.
Yes.
When you have an asset that can fund itself in the first quarter of its useful life, worst case scenario for me, now you have a machine that is literally producing cash flows that you can stand behind.
Mhm.
Anything less than that, no interest. And quite frankly, let me tell you right now, the VCs and the private equity groups don't have an interest either. Um, so I will tell you that the answer to your question is, does the first machine that this company is deploying stand alone by itself and create profitability for the company?
Yeah.
If it requires 10 machines over 10 years,
Yeah.
no, no good. Why? Because that's what everyone's doing.
Yeah.
Because everyone's asking, oh, just give me a bunch of money, I'll make it work.
Yeah.
Sorry, that doesn't work anymore, especially in today's economics.
Yeah. That was a great answer. All right. We talked about this a little bit, but I'm excited to go a little bit deeper. It's like beyond the patent conversation. When investors ask how a hardware company is protected, the reflexive answer is a patent portfolio. From your experience, what actually keeps a physical technology defensible over a decade, and where do patents alone quietly fail?
Great question. This is a passionate topic of mine because um, it's like the easy question that investors always, do you have a patent? Like, because like investors and when they go through due diligence, it's basically like an underwriter.
Sure.
They're paid to find ways in which you're going to fail in
Yeah.
the answer, right? So it's like the easy lob question. Uh, uh, Patents are fine. Utility patents, you should, and when you have a climate tech or hardware company, you need to have a utility patent to cover the basis. Okay. That's just kind of table stake stuff. You need to have it.
Yeah.
Does it matter in the whole global schema? No, it doesn't. What's the problem with patents? The problem with patents is you're literally showing the world how your machine works.
Hmm.
Okay. And that's okay at the base layer, right? But before you do that, you need to have a multiple tiers of process knowledge and trade secret information that you need to feel comfortable with as the operator and the inventor before you're telling the world how it works.
Right.
Why? Because China will knock you off faster than you can actually catch up. As long if you're just why? Because there's listeners and you can use AI now, et cetera. They're constantly just monitoring the patents that are coming through.
Hmm.
They're constantly. Okay. Um, so that's the problem with patents. Patents are revealing, but yes, it does create you a base layer of protection within your core markets.
Sure.
What I have advised companies for basically the last 12 years or so, I tell people get a patent, get a utility patent within your core markets like the US, Europe, can but even the biggest companies in the world, 3M, Cargill, Honeywell, name your company, they don't patent their technologies in every country in the world.
Sure.
It's literally a law of diminishing returns, right?
Yeah.
It's extremely expensive and an administrative nightmare.
Yeah.
And so what these firms, what I would say is learn from these firms.
Mhm.
What these firms know is that there's an incredible amount of obviously brand defensibility once you
Yeah.
have a first mover, but that's more of a marketing sales strategy.
Sure.
But from an IP strategy, it's really that trade secret information of that process knowledge of exactly how it works, not what it is. And so that's what matters more to me is when speaking from an investor now,
Yeah.
is when a company can very clearly articulate what that moat is
Oh.
and what that multi-layered strategy is to protect against a hostile third party coming in and trying to basically just rip them off.
Which you say is inevitable, essentially, too, at some point.
Without question.
Yeah. Okay.
Without question. You will be knocked off in a hardware business without question.
Mhm.
It's how much you can defend yourself by the trade secret information layer. And also, this is not IP, this is business now,
Mhm.
by rewarding incredibly handsomely your entire ecosystem around you,
Mhm.
especially when you're dealing in territories in which not is your core, especially when we're talking about third world countries or even second world countries. Corruption is rampant. When you have a connected ecosystem of good business people around you, which you are rewarding heavily, that ecosystem will protect you because those individuals will protect their own stronghold within that region.
Hmm.
And so this is the number one lesson that I give people that I have learned. What you might learn it out of a book, but I'll tell you what, nothing matters more than when you're constantly getting screwed in foreign countries because everyone's trying to rip everyone off, and there's an incredible amount of bad actors in this space, which is ironic as hell because it's a climate, everyone should be going towards the same goal.
Yeah, no, it's well said. Okay, so next, the market prices asset-heavy equipment makers and advanced materials producers in completely different multiple ranges, rather. When a deployment stage investor looks at a hardware company, how should they determine which business it truly is, and how early in the company's life can that call be made with confidence?
Uh, so what I would say is the market won't price what you make, they'll price how you get paid.
Okay.
And this goes back to the revenue
Yeah.
stream I was talking about, right? And so ultimately, I I would tell people to go back and read the contracts. How is the revenue flowing? If the revenue is flowing from the actual outcome that's being produced versus the hardware that's being sold, you've got a winner.
Mhm.
Saying that differently, if you can get to, again, way overused term, but people get it, a value-based pricing schema
Sure.
versus uh, I have a piece of hardware, I'm going to see how much margin I can make out of it. That's the answer.
Yeah. Great. Awesome. All right. Now, where the diligence breaks, we touched on this a little bit, but those checklists were largely built for software and later retrofitted to hardware. Where does that retrofit fail at the deployment stage specifically? And then what are the questions investors routinely skip on physical businesses and tells you you've learned to spot, and the tells you've learned to spot that never show up in a data room?
The biggest lessons that I have learned are where does the operational risk live on an underlying asset?
Hmm.
Meaning, when a piece of hardware breaks down, who is ultimately responsible for that repair?
Mhm.
And what is the open liability against that repair? And it's the equivalent to the essentially software as a service space. Um, the ironic thing is the software companies know that the software will fail at some point, um, which is why you always have uptimes, you always have clauses saying they're constantly pushing out updates, blah, 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 right? One thing that the hardware companies can learn from the software companies is that you need to get to an as a service contract model as fast as possible
Okay.
so that you keep a connected connection with that end customer to make sure that the customer doesn't screw up your piece of hardware. Why? Because this happens literally every single year, even the biggest companies. And what happens when you're an early stage company, when you have a company like 3M, say you've given us a piece of hardware that doesn't work,
Yeah.
take it back and they sue you, it's game over. Which is why 3M, Honeywell, these guys are so against working with early stage companies because they know that they cannot support the hardware that they're making, even if it's a first of a kind investment.
Yeah.
So, bottom line is you need to get to a point where you have a connected relationship with that customer and ultimately have the customer pay you to make sure that machine is running. And that also helps you on the investment side because you can show recurring revenue.
Yeah. Great. Love that. All right. In another life, you evaluated and procured industrial equipment at global enterprise scale. Is there one specific purchase or eval from that chapter, like a deal that went sideways, or even a decision that aged unusually well, that permanently changed how you judge hardware companies today?
Uh, I'll answer it two ways.
Hmm.
One tongue in cheek, but also horribly painful.
Yeah.
Uh, all the bad actors aside, that are literally just con artists. Um, uh, the how you handle looking at this realistically is you view the asset against a specific market.
Yeah.
And so is an asset, is the hardware company, and usually it's the company, right? Is it attributing itself to a single outcome,
Hmm.
aka a single customer base or a single product set, right? Are they becoming so nichey that they're in a vertical that, to my point, if that vertical fails, or if there's a external market change that's a black swan event, is that company going to fail because the vertical is failing?
Yeah.
I have made this mistake before, to be very clear. I have invested in companies that are way too vertical specific. Why? Because quite frankly, I have made businesses that uh, rely on that term, the riches are in the niches,
Yes. Me
because
too.
it's true,
Mhm.
right? But if it's not defensible enough,
Mhm.
you're going to get in trouble. So the key lesson that I have learned and what I have built ADAR around and other things that I'm involved in is a platform play.
Mhm.
I want to have, to take a Minnesota reference, I want to have 100 shots on goal, make one of them, and still have $1 billion company
Yeah.
versus having a single shot on goal and hope I make it in.
Yeah. Well, good. I have one final question.
Sure.
Would you say the category still has a Wild West quality to it?
In what way?
Well, like more capital than discipline, like more claims than operating history, for example.
I do. I
I'm
actually,
building. I'm building. I'm building. I'm building it. Okay. Okay.
yeah,
Let me ask the second part of the question.
yeah.
As
Go ahead.
deployment stage capital gets smarter over the next few years, what does the shakeout look like, and what will the survivors have in common that today's headlines are ignoring?
Yeah.
That's a real question.
Oh, that's makes more sense now.
Yeah.
There are two parts to this market. Okay. If I'm not answering it how you are asking it, let me know. But there are two parts to this market. And it goes back to the capital source. There's the private equity part of the market, and then there's the venture part of the market. I don't like venture capital in general, but I'll just call it the venture part, which is early stage, right? So there's growth stage, which is private equity. There's early stage, which is venture. All right. The private equity side of the market will always be there and will always fund projects that are slow, not very attractive, but produce risk adjusted returns.
Sure.
Why? Because there's so much capital locked in these private equity funds that they are looking for places to deploy. This is the reason that the solar park ecosystem, I'll just use that as an example,
Yeah.
has been so well funded because you can always sell power into the market even if it's not profitable. You can always make some sort of revenue from it, right? Even though it's really not that attractive
Yeah.
and the return is so long out, but it doesn't matter because there's so much capital. I've worked with firms that have to deploy a minimum of 20 or 50 million per check
Mm.
because they literally can't absorb the diligence risk or
Yeah.
the operations risk of managing an investment smaller. Okay, so that's that side of the market. Now to the other side of the market, the venture side, which is where all the excitement happens. Uh, what's happening is the wallets are getting tighter. And to be really clear, the chasm between private equity and venture is becoming wider.
Yeah.
And they call that the valley of death, right? And what's happening straight out, and I see it every day. If you can't prove that everything that I've talked about in this interview, quite frankly, a defensible,
Mm.
recurring revenue platform that can fail multiple times, because we all know you will,
Yeah.
as an investor, I'm saying,
Yes.
but you can nail it one or two times and you still have a massive business,
Yeah.
only those survive. And unfortunately, I see uh, about 80% of the businesses in this space fail because either they have the wrong management team, they have the wrong market strategy, they don't have recurring revenue, they don't have the right moat, yada yada. So it's the unfortunate reality, and it pains me to say that as an operator,
Yeah.
but it's very easy for me to say it as an investor.
It's very Wild West.
Yes, it is. Yeah,
Uh,
it's very Wild West, and it creates so much noise, right? Like so many of these companies are using a shotgun to shoot into the woods versus using a rifle to shoot an open field at a target.
that's
You know,
very Wild West.
that's it.
Yeah. No, that's very good. Very good, Dan. As always,
Spoken from the heart through a lot of experience.
yes. Always so, always so fun talking to you, even if it is a gloomy day behind you.
I'll make sure to brighten it up in the future.
Yeah, the okay. The
Yeah.
air quality index does not look good for you at the moment.
Yeah. I kind of miss the emojis though. Can we do the emojis next time? We've
Okay.
really had a lot of good feedback on the emojis.
Did we?
The floating emojis.
Just one? Just one? Okay, I'll work on that. It's good
Yeah.
feedback. It's great feedback for the next sesh.
Yep. Yep.
All right, Dan. Well, see you on the next one.
See ya.
High five. High five to you, sir.
Cheers.